Thank you, everyone. So I'll be essentially setting up the context for the panel that Mitul is going to lead. And this is about enabling private investments for climate adaptation. So a lot of what we have heard over the past one and a half days is actually focused on, a lot of it is sort of touches upon climate finance. But specifically, the idea for this particular session was to focus on adaptation as a sort of key area within climate. Now, with that sort of background, I'll quickly jump to the main point, which is that India needs to invest in climate adaptation, and it needs to do this urgently. Now, the urgency comes from the fact that we are ranked 7th most vulnerable country to climate change. And this is very interesting map if you were to see. You will realize that almost 80% of the Indian population lives in districts which are highly vulnerable to extreme weather events. Now, specifically, if you see the areas in the Eastern Ghats, in the coastal area of Gujarat, those are areas which are exposed to flood, drought, cyclone, all three climate events. And then there are other sort of areas which are sort of exposed to 2 of those 3 events. So all in all, almost 80% of our Indian population is exposed to 1 or more of these extreme weather events. And if you sort of see this with the fact that these are also the most vulnerable sections of our society and with very limited adaptive capacity. Now, if one were to just sort of put this in the context, India between 2019 and 2023, we lost USD 56 billion. That is almost close to about 4 lakh crore, perhaps equal to the amount that government spends on the centrally sponsored scheme. So that's the kind of figure we are talking about here. And it affected almost 5.5 crore people. So it's really urgent that ways. And if you overlay this with the fact that almost 3/5 of our country is dependent on agriculture, it makes it even more sort of urgent that we take this very seriously. Now, coming to finance, now financing flows to climate adaptation they severely lag behind mitigation. In fact, if you were to see that graph, the finance that went into mitigation was almost to the tune of roughly 3 lakh crores, which is 44 billion US dollars, and adaptation was almost 1/9 of that. When in actual, what is perhaps required by different estimations is that India needs roughly 80 lakh crore on an annual basis for financing adaptation, and what we really have is just about 40,000 crores. That's the figure there, the $5 billion. So yeah, financing flows to mitigation are almost 9 times higher. And as I said, if you compare what actually flows into the adaptation, this is minuscule, a pittance as compared to the 80 lakh crore, which is required by India on an annual basis. Now, these figures bear out here. If you look at the graph on the left, as I said, whatever are the current sort of flows into adaptation, we need perhaps the 19 times of that. These are US billion dollars figure. We currently have 5 billion, what is needed is $95 billion, which is roughly 80 lakh crores. And this is kind of breakup of that $95 billion across different sectors. I think water, infrastructure, and climate-induced disaster management are 3 areas which will require most of these funds. Now, in terms of, so having spoken about the urgency of adaptation, climate adaptation, the lack of finance that flows into it, what naturally follows is, of course, trying to understand what are those significant barriers to the private investment in climate adaptation. I would broadly club it into 2. One is what would typically be classified as the classic case of market failures or areas which require government intervention. So if you look at on the top left, these are essentially lack of market mechanisms. There are lack of supportive policies and regulations. And one of the biggest problem in this area is the overlapping nature of development and adaptation. In fact, a lot of what Government of India does or different state governments do can easily qualify as adaptation. But because we don't have a taxonomy, we don't have an easy way of sort of tagging which development projects are adaptation, it's really very difficult to say that how much of focus is there on adaptation. The other problem on the sort of the market failure side is the fact that one is there is no common metric for tracking progress. Unlike mitigation, where you have this method of measuring carbon and GHG emissions, adaptation by its very nature does not lend itself well to easy capturing under any given metrics. There is, of course, the issue of limited granular climate data. Now, because of sort of challenges in the public domain, these kind of flow or relay themselves onto I would say the private markets, or what sort of precludes the banking and the commercial institutions from getting in. So one is, of course, the lack of investment-ready proposals. The other specific reason which sort of prevent the financial institutions from getting in is the very hyper-local nature of the projects. Now, what that does is that it kind of makes it difficult to replicate solutions. So if you were to talk of, let's say, electric vehicles lending, once you have sort of cracked that code, it's pretty much easy to use that same sort of template across India. But given the adaptation projects, given their specific nature, what probably works in one geography is not going to work in other. So it does not make for easy replication. Other is the small project sizes and the long investment horizon. So that's another problem that we typically face. And then there is, of course, this difficulty of monetizing public benefits and externality, right? So because the benefits are, of course, spread out, and the cost is borne by sort of one player. So there is that problem. So essentially, these are some of the reasons, and there could be many, but just the top ones, which kind of prevent the entry or create a barrier for the private players to sort of get, or banks or the financial institutions to get in. Now, getting into sort of, so what can be done here, right? So we have been talking about blended finance. I'll just talk a little bit about it on a first principles basis. So if you essentially look, what does private capital, or what does blended finance do? It essentially serves three purposes. One is it reduces the cost of capital, which it does by either bringing in concessional loan or bringing in grants. It allows for financial leverage by bringing in either subordinated debt or non-convertible preference shares, or it can reduce risk. So we know instruments like guarantees, technical assistance, insurance, which will reduce the risk and perhaps create incentives for financial institutions to come in. Now, if you were to look at the intersections of these, we are really talking about FLDG, or the first loss capital, which is at the intersection of reducing risk and allowing financial leverage. You have equity, which is at the sort of intersection of all these three. So there are these sort of different mechanisms which can be deployed to sort of overcome this problem of banks not being interested. I'm not sort of specifically touching upon the innovative financing mechanisms here, because these are, I would say, innovative financing mechanisms are probably the next level workups on one of these solutions. Now, I'll just talk briefly about what is it that sort of MSC has been trying to do in this space for past few years. And again, this is just sort of a quick overview. This is by no means exhaustive. So one of the key projects that we have done is with CGAP. So with CGAP, where we have tried to basically identify what are the risks, what are the climate risks that the communities which have been funded by or given or who have accessed borrowing from financial institutions or MFIs really face. So that's more on the, I would say, on the demand side, where we have assessed what are the risks that these communities face, how have they used existing financial access that they have to mitigate those risks. So that's on the supply side. On the demand side, on the supply side, we have tried to assess for financial institutions the ways in which they can assess their portfolio risk when it comes to climate. So we are working with Bureau in that case. So the piece will essentially be able to guide the response of financial institutions to reduce their clients. There is another project that we are doing with IDH Agri 3, which is towards identifying the market for the climate smart agriculture projects. Now, these are a set of practices and set of technologies which I won't say are fully adaptation focused, but they lie in the spectrum of adaptation. So some are purely adaptation focused, while some have mitigation co-benefits, some are mitigation focused with adaptation co-benefits. But yes, we are sort of working on that, and we'll be able to identify the landscape there. In fact, there's some of you must be knowing about this, that GIZ is working with Caspian and Social Alpha and SIDBI to work on the climate smart climate smart agriculture financing project. So there's some interesting development going on. We are not directly involved, but I would suggest one should really be sort of watching that space, as there's something very interesting happening there. So that's, I would say, on the downstream, where we have worked with the clients and the financing institutions to enable the financing flows for the adaptation finance. We've also worked on a couple of structures of financial instruments and products for building climate resilience. So we have one specifically in Fiji. And we have worked on a few projects where we have helped the government of India with the soil health cards and soil health management program. So that's broad sort of, in very sort of quick way, telling about what is it that MSC has done. This is by no means significant, and a lot more needs to be done. With that, I would pass on the baton to Mitul with just a quick word, which is that we have tried to sort of get a panel where we have different stakeholders who provide a well-rounded view. So we have someone who's from the venture fund space. We have someone who is the market maker on the debt side, so both equity and debt kind of gets covered. Then we have someone who represents the philanthropic capital, and then where all of this lands, which is a climate tech startup. So I hope we have a interesting and enlightening discussion. Thanks.
Thank you, Anand, for a very valuable presentation and also being cognizant of time. We really appreciate it. Moving on to our next session. This session addresses three main objectives. One, uncovering the reasons for the limited supply of debt for climate adaptation in India. Two, how can these market failures be solved? Three, what opportunities do financial institutions see in this space? To discuss the same, please allow me to now introduce our esteemed panelists: Madhur Jain, co-founder and CEO at Varaha; Nalin Agrawal, founding partner at Climate Seeds Fund; Neha Mudaliar, Senior Vice President, Head of Climate Financing at Northern Arc; Siddharth Chaturvedi, Senior Program Officer, Agriculture Development, Asia at Bill and Melinda Gates Foundation; Vinod K. Kala, Founder and Director at Emergent Ventures India Private Limited. And the session is moderated by Mitul Thapliyal, Partner and Leader, Government and Social Impact at Microsafe Consulting. Over to you, Mitul. Thank you so much.
Thank you, Anand, for setting the context very well. So we have a very esteemed panel with us. And as introduction has already been done, so we'll not waste time with the introduction and straight away move to the key question that we're trying to answer. So as Anand highlighted, there is a significant gap in the fund flow in the climate adaptation space. So we would try to understand from our experts what has been their experience, why it's working, why it is not working, and what more needs to be done to ensure that some finance starts flowing for climate adaptation. So I'll start with Nalin from that side. So Nalin, you invest a lot in startups and climate tech startups to be particular. So what has been your experience so far with the startups in terms of the startups that are getting funded? Why are they getting funded, right? And what are the business models which enable that the money is flowing, particularly for the adaptation?
Yeah, thanks. And good to be here. Thank you. I think, as everyone knows, the deal flow in adaptation and resilience, broadly ANR, is definitely lower than what we see in mitigation. I guess the reasons that we see for that, at least at the early stage, is one, the taxonomy is not that clear, and related to that, impact metrics are not as clear as in mitigation, right? So it's easy to see where GHG abatement is happening in mitigation. Here it requires a little bit more work, and that work is happening. It's not that it's not happening, but it requires a little bit more nuance. The third thing is the investment cases, the investment case for several adaptation technologies is still lacking, right? So it's often seen as a space for the public sector or the state to invest in, right? Now this is also changing. I think what I was speaking to a few organizations, global organizations, they're working with large capital asset allocators to define investment cases, and those send signals to upstream, right? So we saw that in 2020 when a lot of asset allocators, changed their investment theses, and it sent kind of signals to upstream allocators as well. So a lot of money flowed into VC at that time. So I think we may see that happening. In terms of, I think you talked about what kind of also use cases we're seeing.
Who are getting investments? What kind of business models are getting funded?
So I think in terms of what's mature and commercialized, I think I'd say that, let's say in built environment, we're seeing something in, so 4 or 5 things, right? Built environment, low carbon cooling, climate risk, insurtech, resilient food systems, also supply chain resilience, and water, right? So these are broadly where we're seeing, and of course, I mean, nature-based solutions is a broad kind of cross-cutting theme across this, right? So within this, there's technologies that are in either mature stage or emerging. So, I think we're seeing some structural materials emerging in built environment. In water, we're seeing much more water monitoring, hydrology mapping. Similarly, in food systems, we're seeing some low carbon cold chains, even, let's say, things that allow lower inputs, for example, right? So I think this is something we're seeing investment flows in, even in terms of using GIS and remote sensing to better predict flood risk and long-term kind of risk, for example, for the real estate sector. That's why we're seeing initial fund flows coming into right now.
Great, thanks. I think with equity investment, now we're to debt investment. So Neha, where do you see, which are the initiatives which are getting debt investments and where Northern Arc is investing, particularly, again, in the adaptation space?
Sure. No, thank you so much. And I think between, Nalin and Anand and you, I think you've covered most of the points on climate adaptation, frankly. I would just like to make the distinction for, the audience here. Robert Swan made a very interesting comment. He said that, the biggest threat to our planet is the belief that someone else will save it. That is so true for mitigation because we're all tied to the hip. Whatever happens in India will affect, people around the world, and whatever accordingly happens around the world will affect India. I think what makes adaptation so challenging and why maybe we see reduced funding for that is because it's a very localized and regional phenomena. And hence, and again, this was discussed, but what is adaptation in one geography might not even be adaptation in another geography. And hence, it becomes very critical from a financier's perspective also, who's impact driven like Northern Arc, to really have that level of country-specific, region-specific data available to see that what are the measures which are going to have the maximum impact within those regions and how do we fund those. So in that context, I like the phase we heard today where there are co-benefits, which we're talking about. And there are some of these sectors, and I think those are the sectors which are clearly getting funded more. I think Nalin mentioned most of them where we are seeing majority of the investment opportunities. Because, and again, this would have been discussed over and over again over the last 2 days, but equity and debt has very different risk profiles. Equity, at least impact investing, we are hoping is more patient, more long-term, and it is really growth capital based on the potential of growth of the enterprise over the next 5 years. Debt capital, you have to start repaying in the next 3 months, right? So it has to be a business model where you have recurring cash flows which you are able to then use for these repayments. So it has to be a business model which is at least EBITDA positive, right? And not only from a lender's perspective, but even from an organization's perspective, if you've taken debt and have not been able to repay, the debt, like debt in the foreseeable future is very little. So from that perspective, again, cutting to the chase, I think the sectors that we have, funded for climate adaptation have been around agriculture, so around water resilient crops, water resilient seeds, drip irrigation, technologies like vertical farming, hydroponics, technologies which are able to increase the yield per acreage. We've also seen very interesting innovations happening in microfinance. And I was at this session which Microsave itself had kind of compared on technologies which can be expanded through microfinance institutions across biodigesters, drip irrigation, water recharging. So again, we are very bullish when two of these business models are coming together. One of microfinance, which is a proven business model of recollections and grassroots presence, and then adding the layer of technologies and use of proceeds for climate adaptation. I think the other sectors where there is a good overlap is things like affordable housing, a very clear case of climate adaptation where you're helping people coming from pakka houses to built environments which are more flood, storm resistant. I think parametric insurance, again, we are talking to some of these entities. Some of our microfinance clients are already doing parametric insurance. Again, huge potential where you don't even have to, identify the loss. The moment a certain environmental or climatic threshold is passed, you get the benefits of that. So I think those are the areas where we are seeing. Even with regard to early warning systems, frankly, we are seeing farmers paying for it. So most of these cases where there is a clear business model today is where we are seeing opportunities.
Great, thanks, Neha. So you made very interesting points about the impact of climate being local, and hence the adaptation strategies also have to be local. In fact, that is something that Siddharth and I were discussing outside. So with this, it's a very good segue to get into Siddharth. So Siddharth, of course, when you make your comments, do touch on the local adaptation and what you are doing there. But I specifically want to understand from you, because you are the ones who are bringing philanthropic capital, which is more patient capital, more risk-taking. Not patient, it's like a sunk capital. You're willing to sink the money even if there are no returns. So have there been any examples that you have seen either through Bill Gates and Melinda Gates Foundation or through other philanthropic initiatives where you're starting to see early indicators of commercial capital getting unlocked for climate?
Yeah, thanks for that very easy question, Mitul. What we are trying to do, as you know, we are a catalytic fund, and we work very closely with, in India and now also in Africa and in the region. We try to align with the government priorities. So our primary audience is in a way quasi-government functionaries. So I'll give you two examples. One is a very recent example wherein we've set up a technical support unit with NABARD. And what NABARD essentially wanted was to add new financial products so that they can fund more green, so to say, whatever green means, green projects. What this TSU will also do is to identify and actually lay a taxonomy that you were talking about, have a taxonomy as to what does these green projects really mean. So when we look at climate adaptation, and our keynote speaker spoke about it, is how much is climate adaptation actually understood? And are we using the right terms? Are we saying resilience is also adaptation? And I think part of the blame lies with people like us as well, who complicate things. So someone will say resilience, someone will say adaptation, someone will say something else, and the science and the practice does not agree. So then what are we terming as adaptation funding and what are we terming as mitigation funding also gets lost. So with NABARD, we are trying to set this taxonomy right. We are also trying to come up with new financial products, and at the same time build this awareness within NABARD, so that when we are talking of green projects, we are not talking of projects that are being greenwashed. So that's a fundamental kind of shift that we are trying to make. The other example comes from Kenya. So my colleague invested in a tool that was built by bankers to assess climate vulnerability of certain value chains in certain geographies. What it does is it gives a score to the banker to say if a particular region and a particular value chain, how climate vulnerable is it? And based on how climate vulnerable is it, they can either fund it or not fund it. And what that has done is, it started with, I think, 5,000 farmers, and it has reached to 30,000 loans, because what it has done, it has broken the information asymmetry of understanding of climate adaptation and climate risk. So the commercial capital as such in adaptation is likely to increase. One of the things I'd like to mention is that when we are extending capital to the farmers, we are not sure, and this is obviously a trick with MFIs as well, whether it is being used for the purpose that the loan has been extended for. So that remains an issue. The second thing I would say is that the risk of climate change is social in nature. Whereas what we are trying to address the risk through is a business model. So there is a fundamental, gap there, because all the externalities are social in nature.
Yeah, so, no, very interesting point. So commercial capital will be able to address, or we are looking at more public finances. I think answer will lie somewhere in between, where we have a mix of public finance plus commercial finance addressing that risk. So with this, now we move to Madhur. So Madhur is deep in the weeds, addressing this problem head on. So Madhur, the proceeds from the sale of carbon credits is increasingly seen as a tool to finance some of the adaptation, and you are doing it right here in many other countries. So what are the risks and challenges? Because now you're working directly with the smallholder farmers. So what are the risks and challenges for smallholder farmers, and how do you at Vara address those risks?
Thanks. So, see, Mithil, if we see the business that we are in, which is how do you quantify the change in practices that farmers are adhering to? So moving from more conventional to more regenerative/sustainable practices, which can help reduce emissions and also sequester carbon into the soil, like drawing down carbon, historical carbon from the atmosphere and putting that back into the soil, right? So that's one element which in itself is challenging, right? So how to do that successfully by collecting enough localized data and being able to build models on top of it, which can help you identify these practices and then quantify the impact of it. I think that's one major challenge which comes with it. On the farmer side, there are certain cropping systems when farmers makes this transition from conventional to regenerative agriculture practice. And I just want to make sure, for clarity's sake, regenerative agricultural practices are not necessarily organic, right? So regen ag on steroids is basically organic. So we are not talking about organic here. It's basically making small changes in mechanical practices on your farms. In certain cropping systems, we have seen that there is some drop in yields, right? So this basically makes farmers a little bit afraid of making this transition, right? And I think that is where carbon credits from our point of view becomes a really important mechanism, because carbon financing basically allows farmers that basic capital which is required to first of all go through that behavior change cycle of conventional to regenerative agricultural practice. That is one. And secondly, and more importantly, the capital which comes in the form of carbon credit or revenue sharing also acts as an incentive mechanism for the farmer to actually go through this change and adhere to it in the long period of time as well, right? So I think the challenge is how do you convince the farmers to move from one practice to another, which they've been doing for several decades, and it's generational in nature. So I think this is where the entire building the agency theory of change from incentivizing in the form of carbon credit becomes important. I think another challenge which comes in, not from the farmers, but from the carbon credit buyers' point of view, is the permanence of the carbon credit, right? So suppose a farmer does zero tillage, which increases soil organic carbon, but what if the farmer in the 4th year decides to till the land, right? And that carbon which was stored gets lost to a certain extent. So how do you quantify that risk? So then I think the financial engineering comes in a lot, that you're working with 100,000 farmers, even if 1,000 of them change, you need to keep a buffer in escrow, which is not paid out until you have seen the performance of the project. So I think by building enough mechanisms, providing the right set of machineries to the farmers and educations to transition, and then by being able to build the right set of technological tools which are science-backed, are able to overcome some of these challenges to level market. And that is what Varaha has done in the last 2.5, 3 years.
Great, thanks Madhur. So now going back to Nalin. So Nalin, you spoke about the sectors which are getting funded, but at the same time there are sectors and subsectors which are not getting enough funded. And I'm sure you will be meeting a lot of founders who are trying to build businesses in those areas. So do you want to talk about those sectors and subsectors which are not getting funded, and what kind of business models they can, say, pivot to get funding at the same time address the challenge of climate adaptation?
Yeah, I mean, that's not so easy to answer, because I think there's a lot. I think one thing, there's certain businesses, at least certain technologies that are in the state's remit. That's very hard for private sector to fund, and that is true in adaptation, right? So there can be things around, flood defense systems, wildfire abatement or wildfire warning systems, which are very hard for private sector to come in and build, right? So there the state should be present, right? I think where we do need much more focus on is managing our water systems better. One, managing, of course, our soil better, so soil health measurement is very critical. It's not that things are not happening. I don't think it's happening at the scale we need it to happen, right? Even having a better understanding, a digital kind of twin of India is something that we should do sooner rather than later. You know, having a clear sense of topography and topology, and to know where risks are, right? Otherwise, you'll have, and this is a business case that private sector can do and work with government. I think the other thing to keep in mind is the state of, like, the Indian state. I include both federal, like central government and state government. They are a disproportionately large funder of adaptation. Often it doesn't get counted, perhaps because, again, taxonomy, but it's a beast, right? So I think one role, keeping that in mind, one role for private philanthropic capital is to work with government priorities and support de-risking of technologies, right? So as I mentioned, those are the technologies that I think should be spurred on, so those are 2-3 things. I think in terms of the other small thing I'd like to just touch, it's kind of related, is the idea of sovereign to sovereign funding, which is important. Oftentimes we try to include technology transfer in that. It's not that straightforward, because IP is typically held in the private sector. When we try to include technology transfer in sovereign to sovereign funding, it doesn't often work. So let private sector focus on that. Right? So keeping all this in mind, I think these 3-4 areas, I think water, soil, of course, resilient food systems is critical, right? Cold chains, which we're just not there. Precision farming, of course, Neha mentioned, it's coming up. We definitely need much more deployment of capital, new technologies to come up there. It's not that they're not there. Oftentimes, in adaptations, it is not just a technology development, it's also a deployment challenge. In the built environment, I think 70% of India's built environment or building stock is yet to come up in the next 50 years. So we have to be sure that we actually use low embedded carbon materials, right? Starting now, the way this is long lock-in infrastructure. And operational emissions also increase if you don't have the right materials, right? So I think these 3-4 are critical in terms of technologies, which we need to work more on, both on development and deployment.
No, great point. So yeah, of course, there are some sectors which we think are the specific purview of the public sector. And I think particularly in India, governments tries to do pretty much everything, right? Which many other countries don't try to do. So private sector's role is for that reason is also eliminated in some sector where innovation can happen and private sector can play a larger role. So just to take an example, so earlier, space science used to be the exclusive purview of the government. Now it's not, right? But now in India, still a lot of areas are there, which I'm sure with future they'll get unlocked. So Neha, coming back to you. So of course, flow of funding is an issue. So I'm sure it's an issue for you as well to raise money for yourself and also for the downstream companies that you are funding. So what do you think can be done to make the climate and adaptation in particular attractive for commercial investors? So when I say what can be done, is there some sort of guarantees mechanism? Can public sector play some role or government plays some role, or there's some other things which can happen to ensure that this more funding flows into this sector?
Again, I think, the critical part of this is really the taxonomy. I mean, there has to be a common language which banks and financial institutions can talk about, and a very clear green taxonomy which gives specific examples of projects and activities which would qualify for climate adaptation. Because if you think about climate adaptation, it is so vast and so complex. I think it's much more difficult to quantify compared to climate mitigation, because you're talking about resilient cities, you're talking about resilient communities, you're talking about resilient livelihoods, you're talking about resilient infrastructure, and then you're talking about nature-based solutions, right? So, and in each of these, and Standard Chartered and KPMG have, in collaboration come out with adaptation and resilient guideline. I think whoever is interested in the topic should definitely look at it. I was going through over it a couple of months ago. It lists at least 100 activities which could qualify under various terminologies of climate adaptation and climate resilience. But without, that kind of awareness being created in the market, most people are not aware of it. So I think it is very, very critical. I understand where the apprehension of the government and the regulators coming from, because the moment you put a definition, you are trying to weed out some things which might also qualify for climate adaptation. So keep it inclusive, but at least give some specific examples, right? So I think that is very, very critical. I think the second point again was mentioned is having simple, measurable targets, right? Because whenever we are providing financing and we are getting financing from DFIs and other international lenders, each of them want to see the impact of that financing, right? And very measurable, quantifiable impacts over the period of their financing. Now with resilience and adaptation, that is very difficult, right? So then what do you do? And I'll give you some examples. Sustainable agriculture, and we've spoken about that, across the panel. Now sustainable agriculture will have multiple benefits over a period of time. So how do you measure that and how do you quantify it? A simple way is just say that as long as you are clear it's sustainable finance, then just keep a simple measure of how many acres have you done of sustainable farming. And just keep that as a measure and say where did you go from the baseline. So very clear, good taxonomy with clear examples and good impact measurement services. The third point, which comes very critical in nature-based solutions, in common goods, is that the intervention might be somewhere else, and the benefit of that might be somewhere else. And I'll give you an example. In my previous organization, we were working on landscape restoration. Now we were doing landscape restoration upstream in a river, and the end beneficiary were the cities which were getting drinking water from that river. Now that is about 200 kilometers away from where the investment was happening. So then you need innovative systems in terms of payment of ecosystem services. Where you're saying that the residents of this city are then paying for interventions with regard to agriculture and farmers, doing more organic farming and forestry in upstream. So I think those are the kind of mechanisms. I think third, we must have again heard this again and again, we definitely need blended finance, some kind of subsidy. I think we are not getting it, and hence we are not able to pass it on to the end customer. But whenever we speak to any of them, the fact of the matter is that the cost to do anything in climate today is more expensive than traditional way of doing things, just because that is the way it's been done for the last 40, 50 years, right? So even though you might recover it over a period of time with reduced operating expenses, and the payback periods might be quite small, you have to incur an additional initial cost for measurements, for technologies, and for certification. So if there's some kind of subsidy which is available, blended finance which is available, some kind of payment guarantees where your counterparties are governments or municipal corporations, I think those are things which are really required. Thank you.
Yeah, definitely. So I think that's a role where the public sector can come and governments can come in a big way by providing blended finance kind of structures. Even philanthropic capital can play some role in catalyzing some of those things. coming back to you, Siddharth. So if you look at this whole debate around climate, it was very hot in the early 200s, and then it's slowly dried down. And again, in the last 5-6 years, it's again come up. And I think from at this time, it'll go up and up from here. I don't think we are going to see any dip in the seriousness that the world is giving to climate. So, from the Gates Foundation's perspective, and also in general, I'm sure you would be interacting with other philanthropies as well. How do you see next 5-7 years, if you have to paint the role that philanthropies can play in the next 5 to 7 years in the climate adaptation and climate in general? How would that be?
Hello. Yeah, I think there is nothing new. So I cannot say that. I think what Neha mentioned was very important. That we have to have a cross-sectoral approach. So that's one. And the second thing I think some of us are moving towards is a long-term view of climate change impacts and having projects tailored to that. So typically, like the foundation makes investments of 3 years, 4 years. Now we are moving towards 5 to 7 year investments. And our linkages with the larger lenders or sovereign lenders, and obviously the government institutions. So I think one on the cross-sectoral, two on the long-term capital. The third piece is obviously the introduction of technology, but making it a public good. So the whole awareness piece is not just a matter of advocacy, but also translating it into tools. Which tools are, and tools for whom? So the tools for the government will be different from those for the private sector, but they need to be usable. So if we say we are working with the CG system on, or the ICR system on developing science, how does that translate into a tool, like the tool I mentioned for lending? The last piece is, I think, and this is very important, is going local, which we spoke about. The locally led adaptation, and the locally led adaptation cannot be a copy paste of what is happening elsewhere. So I think the appreciation of what is a local vulnerability and creating solutions there is very important. So just as an example, one of the things we are trying to do this year is to work with extremely hyper-local not-for-profits and providing them with the right capacity so they can inform their farmers. What that does is it also in turn tells us that the tools that we think should be used, that the farmer should move to a different value chain or a different practice, are we informing them in the right way? And if that catchment of certain, let's say 20,000 farmers per NGO can kind of move to a different practice or are more informed, then the multiplier effect is very high. It's still an experiment, but what's important is, as I said, we need to go cross-sectoral, we need to go local. Those will be the two things I'll say, and obviously have a long-term view. We cannot say, so what happens in the next 3 years? I know you're talking about metrics, but I think there's nothing new. At the end of the day, for agriculture, we have to look at the seed replacement rate. We have to look at varietal replacement. We have to look at water usage. So new metrics may not be needed, but they need to be identified as adaptation metrics. I think that's the only change.
Great, thanks. Yeah, please.
I've been in this space since 2007-8, like at Clean Tech. We were entrepreneurs in the solar and the wind space before this. So it's very hard to know. I mean, we had a failed startup at that time because it was very hard to predict the market, you know, so I don't want to do that. But I will say that in the last 16 years since we've been here, there's some fundamental trends that we're seeing now which weren't there before, right? There's certainly, I think today, I think the 75% of the world's population lives in areas where the renewables are the cheapest form of power generation. That's a sea change from when even I was in the solar space. The business case for several decarbonization technologies is very clear, right? Very, very clear today. In the last 3-4 years, this has happened. The third very important thing, at least from our vantage point as early stage kind of supporters of climate tech startups, is we're seeing a critical mass of really great entrepreneurs coming into the space, right? One thing is clear, that a good Indian entrepreneur has a very high opportunity cost. You can become a logistics entrepreneur in the US, you can become a fintech entrepreneur in Sweden. If you become a climate tech entrepreneur in India, you've taken a considered bet with the next 5 to 10 years of your life, right? And they're smart people, right? So that's a very good signal for us that there's a critical mass of excellent entrepreneurs entering the space. So I think that bodes well for the next few years.
Great, thanks. So Madhur, I'm already getting signal that we are over time, but yes, definitely I'll ask one question to you. So it's a two-part question. So one is, what kind of technologies are you seeing, or would you want, or you are promoting on the ground for these adaptation efforts? And the second part of the question is, what do you see as a risk for this whole carbon markets? So risks have been coming and going, but what are the risks that you see right now and emerging risks?
I think it's a hard question to answer, but I'll try, given the paucity of time. So see, fundamentally as a business, what we are trying to do is measure natural capital with as much integrity as possible, right? And if you're working in a country like India, and especially focused upon smallholder farmers across South Asia, Sub-Saharan Africa, like Varaha is, you can't do that successfully and at scale with a business model unless you have a tech and science model built into it from day one, right? And so I think when we talk about natural capital, there are different elements to it. So one is water, biodiversity, soil health, and then carbon, of course, right? As of today, the market is myopic in nature. It's only valuing carbon part of it. But if you look at biodiversity, water, soil health, these are other markers of adaptation which are independently or indirectly being funded under the hood of carbon, right? Carbon financing comes in, does sustainable practices on the ground, but it contributes to all the other parameters which I just mentioned as part of the metrics of the natural capital metrics. I think the day we start to sort of value all of these other elements, I think it will become so compelling for farmers to do regenerative agriculture that you don't really need to sort of talk about behavior change that much. Today you need to, because carbon is the only part which is being monetized or being paid for. So I think that's one element. So how technology is being utilized is that collecting enough training data on the ground so that you're able to use that to build models on top of it to identify different practices, right? Whether it's dry seeding of rice, zero tillage, crop residue incorporation, all of that can be monitored through satellite, high quality satellite data if you have enough training data being collected from the ground. So that's one piece of it. The second is, once you know which practice is going on, how do you quantify, right? How much soil carbon at a farm level is being quantified or stored into the soil? That's the second critical piece. So that's where you need to work with the institutions, agricultural research institutions, like we work with IRI and IIT Kharagpur today, to set up experiments on the ground in different agroecological zones, through which we are able to see that by changing your behavior, how much gas fluxes you are able to reduce across carbon dioxide, nitrous oxide, as well as methane, plus what's the delta soil organic carbon change at a farm level, right? So an amalgamation of ground data collection plus satellite plus biogeochemical modeling with all of this experimental data is required to create a high quality carbon credit, which can then be traded in the international market at a premium, which then creates enough incentive for the farmers to do these practices at massive scale. I think the risks are, I think I touched upon it earlier as well, that if a farmer changes behavior and practices, and if enough of them do this, then there is an inherent risk to the asset itself, which is carbon credit, right? And this is where I think a hedging mechanism of valuing some of the other assets also become really important. I'll take a pause because I think we're getting signals. So.
We're getting a lot of signals. But anyways, so I wanted to open it up for questions from the audience, but we can take only one question if there is any question, but our panelists will be around and you can catch them if you want. Anyone has any question? I can't see any hand yet. Okay, so in the interest of time, I'll quickly summarize. So we touched upon various topics. Of course, taxonomy as a key area where we need to work on came up multiple times, multiple panelists spoke about it. the need for solutions to be local and the approach to be local and the local-led adaptation approach also figured out. We need to look at new business models, and when I say business models, not just in terms of the solutions they're offering, but also the upstream, how they're getting funded in terms of blended finance solutions, doing the financing app, etc. Technology and science-based solutions, so which Madhur spoke about, and that's quite very important. They'll play a critical role going forward, and we are seeing a lot of progress in this area in India and also globally. Interesting point is no new metrics are needed. Of course, we already have metrics, so we have to do more and now show some progress on those metrics. And the patience is key to solving the climate challenge. So it's a very hard problem. It can't be solved in a year, 2 years, or even 3-4 years. So we need to see long term. So that touched upon it, the need for long-term capital, and all of you touched upon it in some ways. So I'd like to thank you for sparing time for this very interesting discussions. We'll continue the discussions offline, and I'm sure people would have learned about it. Thank you very much.